Hello, this is Jordan. Thank you so much for joining me today. This video is being recorded on the early afternoon of Monday, April 3rd, 2023. And in this video, I'm going to look at some potentially comparable periods in gold, looking at how gold performs in terms of corrections early in a new bull market or a strong rebound. So I wanted to look at those and see if we could gain any insight on potentially what we could expect over the coming months and quarters as this bull market, I shouldn't say get started, but as it continues and potentially accelerates. So looking at the early 70s, of course, 1971, the link between gold and the dollar officially abandoned, the complete end of the gold standard. So gold had a huge move from the end of 70 into, I believe it was 74, but I'm showing the first couple years here, and the blue is the 50-day moving average, the red is the 100-day. So I'm going to look at those two moving averages and also the 150-day, and we'll see how they provided support, in which cases they did, in which cases they did not, early in these new cyclical bull markets. So in the case of the early 70s, the first year or so, year and a half, 2 years of that move, the initial support was provided twice. You can see there in 1971 after August, where gold tested and successfully tested the 100-day moving average in red. So I'm going to go through all these and make a few conclusions at the end. So here we have 1976 to 1978. The darker brown line there, that's the 150-day moving average. But if we focus on the blue arrows and the blue line, which again is the 50-day moving average, we can see that that essentially provided support twice within the first, call it 5 or 6 months or so of that move, essentially at two different times there. I did not calculate the percentage declines there, but I think those first couple ones were 6% at the most, maybe even less. Now, interestingly, nearly, let's call it 9 or 10 months into that move, the 150-day there where gold corrected 11%, that was the first correction. It went a little bit below that moving average. That moving average continued to provide support for a couple more months. Then the rally, or I shouldn't say rally, the bull market move really continued. And then the next decline came down to the 150-day moving average again. That was a 12% decline. So keep these figures in your mind as we go through this. So next, looking at the mid-2000s, not the best comparable period per se, but what I'm looking at is gold had a huge breakout later in 2005. It broke out from a 20-plus year downtrend line in the move in gold from the low to mid 400s up to 720. That took gold to basically, 22, 23-year high, something like that at the time. So, that was a really, really significant breakout in the sector. The bull market really got going. It still had some significant corrections there along the way. But if you're looking at from the beginning of that move over the next 6 years, gold did more than 4x. Think about it. If gold did, if we use 1650 as the low and gold does more than 4x over the next 6 years, that you would be looking at a gold price of, what would that be? Close to 7,000 in 2028. So it's just one comparison. But anyway, I'm getting off topic here. We can see that this move essentially, in November 05, it came close to testing the 100-day, but not quite. It also tested the 100-day at the very end of August 05, before it just started to really begin that breakout move. So you had the two tests of the 100-day, and I'm going to come back to that in the last slide. But then as the move really got going, when gold's breaking out and it's really running, the 50-day, that's really the moving average that matters. So, of course, after a year, gold had a bigger correction. But that's really the key takeaway here is Twice it tested the 100-day, very early in that move. And then, as the move really gets going and it's really accelerating, the 50-day moving average, that's the support once you're in that acceleration. Okay, so getting closer to the present, here's 2008 to 2010. I mean, this was a little different because 2008, gold had a huge move from, the upper 600s up to 1,000. And look at that. That was 4 months. So that was a really sharp move. And that, of course, would take some time to digest, to be worked off before gold could break out. And so given that was such a sharp rebound, looking at it, I think it was roughly 40% from the high 600s up to 1,000. So in the middle of that move, you had a 10% decline. Then you had a 14% correction initially to work off, the very short-term overbought condition. Of course, the gold had a huge move lower. There was a lot of volatility here, so the moving averages were not that far below where gold was. But again, so you had a 10, 14% correction. And initially, the very initial 10% correction there at the beginning or the very end of 08, that came down, bounced at both the 50-day and 100-day, something to keep in mind. But as the move went along, you can see there, it did have one test of the 100-day in April, but almost tested the 150-day. Again, the thick brown line, that for the most part, that 09 through 2010, that period when gold went from the mid to upper 800s up to 1,400 or so, and eventually high, you can see there at the brown arrows and the brown line, that provided support numerous times. And you had a 15% in 2010, then a 9% after that. So, I mean, once gold gets going, in most cases, you really don't see, these significant pullbacks. And one thing to keep in mind, okay, so look at the 14%, look at the 15% pullback, and look at what happened before those corrections began, or I should say exactly when they began. Look at gold. Gold was stretched. It was in February 09. It was quite a bit above the 50-day moving average. Same thing at the end of 09. You can see how far above the 50-day moving average it was. So, that's something to keep in mind. When gold accelerates, it makes a run. Then let's say it gets very overbought in a short-term situation. And again, this has to be after it's gone up a lot, not just because at the beginning of the move, you can get really overbought. That's not bearish. When you get really overbought after running for a little while and making huge gains, that is when it's bearish and a correction could come. So the point basically is, if gold gets really stretched on a short-term basis, it's already broken out. That's the point when you could look for that 12 to 15% correction potentially. But again, we don't have that, at least not where we are right now. I don't see that coming. Okay, so the most recent one, aside from present, the big breakout in June, July of 2019. Okay, before that, gold corrected 6%. You can see bottomed at the 150-day again, went a little bit below the 100-day. Then it had an 8% correction. Of course, you had the Black Swan COVID 15% correction. But again, look at this breakout move in 2019. I mean, that move right there didn't last that long. We could see it was above the 50-day the entire time. And then looking at 2020, if you look at the spring, April, as that snapback, that sharp snapback got started, and gold was able to, essentially rally from the 1500s up to almost 2100, the majority of that move, it basically held above the 50-day. So again, this is one important conclusion we can see, is that when the market is really running, the 50-day moving average is going to be support. So that's one significant takeaway. Now at present, what we see, interestingly, the last correction was 8%, and that's looking at all these charts here, that's in line with what you see at the very beginning of a rebound or a new cyclical bull market. So it clearly aligns with the case that we're in a new bull market. And if you look at the two red arrows, we can see gold already tested the 100-day moving average twice. If you go back and you look at what happened before and at the very beginning of the 05 breakout move, it tested the 100-day moving average twice. So somewhat similar to 2005 there. If we're looking at, before the 2019 breakout, there was a 6% decline there in 2019. If I didn't say that, it was 14% in 2009 before it really broke above 1,000. Remember, it got really overbought on a short-term basis. So, where we are here and now, does that mean that gold is going to set up for, 6, 7, 8% or even a 10% correction here? Gold's a little stretched in the short term. You can see those moving average. So it is possible. I mean, one scenario you could potentially see is maybe gold from here is able to rally to, let me call it 2050 or 2075. And then it has a 6%, 7% correction from there. Because if we're looking at, okay, if gold's going to have that kind of correction, where would the support be? I would probably say, 1920, 1950. So that's one scenario, is you could see gold, continue this move, which is a little extended on a very short-term basis. Maybe gold continues up to 2070, 2090, maybe even 2100, where it's basically almost starting its breakout move. Then you get a snapback at that point, or a little correction to 1950, maybe 1920 at the worst. And then that would set up for a real beautiful, significant breakout. So that's a run through all the history here. I think, one strong takeaway is that, and I've said this 2 or 3 times, when the market really runs after the breakout, that's when the 50-day moving average is going to be the most significant support, when it's really running and it's accelerating. So definitely keep that in mind. The other thing, it's a bit difficult to quantify what exactly is happening before the breakout, on a very short-term basis. Again, I mean, every situation is different. I mean, 6% correction before the 2019 one, 14% before the 2009. I mean, those are just comparisons, but they're not necessarily the best comparisons, because the structure of the market is completely different. How long the correction was before that, how overbought the market is, what does the COT look like, how far above the short-term moving averages is the market. So I know I'm just trailing off here, but those are the things that there's so many differences there that it makes it really difficult to say, well, it was 6% correction before the 2019 breakout, 14% before 2009. So, maybe it has to be one of those. Doesn't necessarily have to be. So, yeah, just to repeat what I already said, one scenario is we could see this short-term move continue up to 2050, 2070, and then you get a snapback final correction to 1920 or 1950 before the breakout. I mean, it's just a thought, just a guess at this point. But look, once the breakout does happen, don't expect any big corrections until the gold price is, much, much higher, maybe 2,400 or 2,500. That's also another important takeaway. So let me know what you think in the comments. Talk to you again in the next video. Thank you so much for tuning in.